Welcome to the Corporate Treasury 101 podcast. This is the second episode of our series on interest rates, inflation, and their implication on Treasury activities. It was very important for Hussam and myself to properly break down the different elements at hand here. In the previous episode, we walked through what interest rates are exactly and what they represent. In today's episode, we developed on monetary policies, what they consist of, how money is created and its flow regulated in the economy. We also talk about what printing money really means nowadays and much more. We really liked working on this episode. Hussam and myself are economics enthusiasts and we learned a lot during our research and discussion. So we really hope you will enjoy the episode. Let's get on with the show.
So you said that also money is a commodity, as
Yes.
in money is like a object which the demand for money and the supply for money changes over time.
Yes.
And because of that, you set your interest rate because it's more expensive to have money or cheaper to have money. That's a really weird term.
Okay.
So because people don't think about, I don't even think about money like that. So how does the supply of money change? You're not burning dollar bills.
Basically, you better not. I mean, you can, but that's not the recommendation for sure.
Is it like, money gets lost in the black market? It goes out of the system maybe. But
That's interesting.
that could be one way. You could burn cash. You could lose your wallet. I don't know. It gets, lost. But
Exactly.
I'm guessing that's not substantial enough to be say that's how you lose money or the
Exactly.
supply. What's the loss of money in?
So that's a very interesting question. Let's have a big picture overview. Let's take the economy as a whole here, and not just you and I who can eventually lose or burn money in it. So, and actually, just for the record, money can be destroyed via a specific technique that bank applies, but let's not focus on that for the moment. It can also be taken out of the markets, of the overall economy. In order to get there, let's first tackle how money is created, right? Because before destroying it, you might want to have to create it. So it all begins with central banks, which are in charge of what we call the monetary policy of their country and or zone, for the Eurozone, for instance. We're going to come back to it in a second. So we will also come back on the monetary policy, but typically we look at institutions such as the US Treasury Department, which has the ability to create money, and the Federal Reserve in the United States again, which is the equivalent of a central bank. And they both influence the supply of money in the market. Its European counterpart is an institution that you might have heard of in Brussels, is the European Central Bank. It's located in Germany, but it's part of this overall European
ECB.
institution. Exactly.
Yes.
Perfect. So you also might have heard about what we call printing money, or the central banks printing money, which leads to money creations, between brackets, from the source, right? Now, this is a bit of an out-of-date concept, plus it doesn't exactly work with a printer anymore, but there is some interesting notions to take out of this.
Central banks are the ones that are controlling how much money is in the economy
Exactly.
as a whole.
Yes.
So they're the ones that get to decide if they're going to quote unquote print money or destroy money.
Exactly.
Right? So they're the ones that are managing the overall supply of money in the economy
Yes.
via something called monetary policy,
Exactly.
which I think comes up in the news quite a lot. Monetary policy, this, monetary policy, that.
Absolutely.
In the US, that's the US Treasury Department and the Federal Reserve, right? And in Europe, that would be the European Central Bank.
Yes.
Difficult question. Are these government agencies?
That's a good one. It is not. So they are autonomous institutions, separate ones. Obviously, they are linked with the government, so they communicate between each other, because we're going to come to it a little bit later on, but there is also what we call the fiscal policy, which allows more or less how tax and money is set on the market. But they're independent, so they're meant to be taking decisions on their own and make the economy thrive more than anything else. So they are not ruled by government. Governments do not have an influence of them. Or let's put it this way, they do not control them, but they influence each other indeed.
So they're public. They're not private institutions, though.
So they are not private. I'm a bit out of my comfort zone here. I will say they are public, or at least they act for the greatest interest. So the interest of the
economy and
exactly.
Okay.
So in that sense, we could say that they are like manufacturing the future of the public, the overall citizens.
But these are different to banks like Barclays and Citibank and
Absolutely.
ING and
Yes,
things like this.
we're not talking about the same banks
Yes.
here, indeed.
These are centralized banks. Clear.
Yes.
So the way central banks increase the amount of money is not the printers, but they create this money.
Mm-hmm.
How do they enter this money into the economy? So how does that end up in my pocket as a member of the economy?
Yeah. So obviously they do not print money directly, right? But there is a notion of freshly created money. Central banks increase the amount of money by buying securities on the markets. So on the stock markets or any other thing. Securities that can actually be any financial product. But they usually buy what we call government bonds or treasury bonds in the United States, which are considered the less risky financial products since they are backed by the governments themselves. This way, with money that wasn't on the market yet, so they are only at the central bank, those central banks buy those securities and therefore introduce this freshly created money into the economy.
So they make money and then they go around buying financial products like bonds.
Exactly.
But who are they buying? So they take a bond, they give that person cash, which they just made.
Mm-hmm.
But who are they buying from? And how does that money eventually get into the economy then?
So the bonds are issued by the government typically,
Yes.
right? The government says, okay, I need to finance this new hospital. I'm going to borrow some money. I'm going to issue a bond. They put it on the market and then it's different agents, different financial institutions, investment banks, commercial banks, all these hedge funds, all that stuff. Those people that can act on the stock market and on the financial market say, okay, I'm going to buy those bonds. And the central banks then say, okay, I'm going to buy you back these bonds, for instance. Or they can buy directly from the government when they issue them. Financial institutions, other than the central bank, buy it with money already in circulation in the market. Whereas the central bank, when they will buy one, they will put money in the market that wasn't there before. Is that clear?
Yeah, so the government will be creating projects for which they need to fund.
Yes.
They fund their projects or initiatives or subsidies or whatever via government bonds. So
Yes.
they create bonds. They say, hey, look, guys, we're going to start this initiative. Let's say we want to build a hospital or some bridges or something like this. So therefore, we're going to issue bonds so that we raise capital for it. We raise money for it.
Exactly.
Those bonds can be bought with existing money in the economy, which is from private people like you and me or institutions, right?
Exactly. It's an investment, huh?
It's an investment, indeed, government bonds.
Yeah.
Or the central bank can buy the bonds from the government from newly made money,
Exactly.
therefore injecting money into the government, who then spends it in the economy,
Exactly.
which then puts the money into the economy. The contractors get paid by the government. The materials are bought from private companies by the government. So that money enters the economy from government spending.
Exactly.
Okay,
That's it.
very clear. So what if they want to take money out of the economy? So that's how they put money in. How do they take money out then?
And that's where it gets interesting. So they basically do the opposite. Rather than buying securities, so we focused on treasury bonds and government bonds because that's the main product, but it can be any other. So rather than buying them, they sell them. So they are taking money out of the economy, right? They are sitting on a pile of securities, financial products, government, treasury bonds, and others. And now they are selling them. So in exchange for the security that they were holding, they are getting money. But then the money is not on the market anymore. It sits at the central bank, which is its own separate financial institution. And that's how they will do it. Open market operations is the name we give to all this, when central banks buy and sell securities on the open market.
Okay. So to summarize, the supply of money, so how much money is available in the economy, is regulated by the central banks.
Yes.
The central banks do that by buying and selling government bonds, typically,
Yes.
or other securities, let's say.
Precisely.
So they're making new money into their bank account, let's say. So they're authorized to do so.
Exactly.
And then they say, okay, we're going to go out. We made this new money. We need to go out and spend it so that it gets into the economy, they go buy bonds and stuff like this, and then they hold the bonds.
Yeah.
And when they decide, okay, there's too much money in the economy, they then sell the bonds. So they give people bonds, and they take cash out of the economy and hold it.
Indeed.